Welcome to the Real Advisor Podcast, TRAP, TRAP. Please follow us and join in the conversation on Twitter @Advisor Podcast, where you can suggest ideas and themes you'd like the TRAP team to discuss. Also remember to like and subscribe to our YouTube channel and leave a 6 out of 5-star review on iTunes. Doing all this really helps us, which means we can do more to help you. Now let's head over to the studio for the latest pile of TRAP.
Yes, indeed, dear trappers. Welcome back to what many people are calling episode 73 of the Real Advisor Podcast, TRAP, TRAP. My name is Lick Lincoln, and joining me as ever are the three other horsemen of the apocalypse. Alan, the Storyteller Smith, Andy Ultraheart, and Carl, the Voice, Della Voce Widgeon. Now, gentlemen, we have a show packed full of absolutely nothing. So let's start unpacking it straight away with some more high-energy review read out by my very good friend, the Right Honourable Mr. Andrew Ursane Hart.
Thank you, my friend. The band's back together. One review today. We're running a little bit short, but at least it's a 5-star, not like the previous couple of 1-stars we've had, but all is good. This is from Matthew Slessor, 5 stars, entitled Team Meeting. I own a small IFA practice in Carlisle, and this brilliant podcast helps me keep up to date on relevant advisory issues and topical events. Great content. Keep up the good work. Back to you, boss.
Great stuff. Thank you, Matthew Slessor. Thank you for giving your name, and thank you for the positive review. We do appreciate them. We don't mind the 1-star reviews either. Well, we don't want the 3-star reviews. If we start getting a swathe of 3-star reviews, we're going to can the whole thing. Okay, let's put a topical timestamp on episode 73 by addressing some topical tidbits. Quite a bit going on. Obviously, Wodge wasn't around for the last episode. We had Rob Stevenson in his place, and that was a very well-received episode. So, Wodge, the pressure is on, and we have a carry forward item for you from the previous episode, and you're going to start us off with small caps.
I am, but first of all, can I just say thank you very much to Rob. I thought it was a really good episode, and lots of people told me, in fact, it was the best episode ever. So thanks to everybody who gave me that feedback. I really appreciate it. But genuinely, having someone like Rob in, who's just, he just knows his stuff. It was absolutely brilliant and great to get an expert and an expert view. So this article
as opposed to us.
Yeah, well, he said it himself. You know.
How was the wedding? Moderate drinking? How was it?
Well, it was a good call to give the podcast a skip. So moving swiftly along. So this was an article I found. So look, it can sometimes be difficult to, I suppose, explain to clients as to where your investment philosophy is coming from. And this article kind of, basically is saying there are some people arguing that the small cap tilt should be ditched altogether and it's no longer something that's going to derive value for clients in the long term. It's a nice little short article. It gives a couple of 3 or 4 points as to why the argument for including small caps. I thought it was really nice, really short, good little piece that, if you want just a couple of points to be saying to your clients. There's a couple of interesting things, like there's 8 years of underperformance now, right? So it's kind of, I think there's a lot of us sitting in our seats saying, right, we wouldn't mind to see a couple of years of outperformance. But the article does say that between 1989 and 2005, the small caps underperformed, but then they came good. So look, I suppose it's the age-old challenge here of explaining to clients about the nature of long-term investing. And that difficulty, saying that, long-term investing could be 20, 30, 40 years. So it's tricky, but I just thought a nice article to give you a couple of pointers.
When it comes, the small cap premium comes in bloody great big waves. So, it's there. And that suddenly then will make the last decade or so look way better. It just comes in, has come in massive chunks, the small cap premium when it turns up.
It's interesting, though, isn't it? Because this is all about relative performance, right? So, and relative because it's mega cap, i.e. the Mag 7, is true. No one can compare with it. And I mean, we might have to wait a fair bit longer. If you listen or watch, as I do, I think most of us do, the All In podcast, all these kind of tech billionaires. Not anymore. Too political for you, Carl.
It is.
I'm sorry. It has got a bit political. But these guys are deep in the weeds of the tech scene, and they see how AI innovation, and there's clearly those established players, the big the Googles and the Metas and all the rest of it. They've just got such a huge advantage now because they've got a network. They've got the network effect, and you just wonder. Of course, things are cyclical. Things come through, but we might have to wait a bit longer because those are likely to dominate in the eyes of those guys who know far more about it than we do. The big mega caps likely to dominate for a fair bit longer because of their established position versus the kind of new upstart businesses.
It's astronomical, the numbers, especially even companies like Microsoft. It's just insane how big they're going to get, and they're already ginormous.
It's interesting to read some of the amounts of money that those mega caps are investing in AI. But also the long lead-in time that they're prepared to wait.
Yeah,
so they're investing
they can burn money for years,
hundreds of millions to not get left behind.
Billions.
And understanding that this is not going to generate return for them anytime soon. But if they don't do it, they'll be the Kodak. So they have to do it. So that's we totally went off on a tangent there, as we tend to do. But
let's just bring it back on side if that's okay. Yeah. So we're talking about very successful mega cap US tech stocks. Smithy, bring us back down to earth with UK micros.
There's an article I picked up last week, and we've actually talked about this before and predicted it as it would happen. It was focused on the AIM market. And Carl, I think that's the kind of more the micro cap that sort of sits beneath the FTSE 250, effectively smaller businesses, and was created years ago to create opportunity for capital raising, liquidity, etc., for smaller businesses that they're not FTSE size, FTSE 100, FTSE 250 size yet.
There might be soon because there'll be nobody left in the FTSE 100. Well, but anyway,
that's
AIM are moving to the FTSE 100.
Still
by default,
still bigger than the Irish stock market. Calm down, Carl. Calm down, Carl. Anyway, but of course, what happened, of course, in her wisdom, our current Chancellor, Rachel, halved the tax benefit. There was one of the, as we've often said, incentives drive behavior, as Charlie Munger has been quoted saying several times in the past. And I think one of the attractions, of course, of investing in these smaller cap businesses was you got quite a significant tax break in doing so, certainly an inheritance tax break. Multiple companies, fund managers, microcap stockbrokers and portfolio managers created portfolios predominantly, letting the tax tail wag the investment dog in that, look, it is more risky, it's more volatile, but if you popped your clogs, they are inheritance tax free, effectively. So that
if only it worked.
Yeah, if only it worked.
It sounds great.
So, but that has been halved, that benefit. So a lot of people who held investments in that are looking elsewhere. Some of the companies that are in AIM are looking to exit AIM either for a full FTSE listing or go elsewhere because some of the capital is dried up. But the other thing worth noting on this, despite all the kind of positive benefits of it, the actual Andy, you and I have spoken about this in the past as well. The actual returns.
Yeah, we covered this before.
The return. It just says there's been a lack of appetite for some time now. The investments have dropped 28.7 of the last 3 years in AIM.
Declined by a third.
In the last 3 years. Against the backdrop of how mega. I was just kind of related to our previous point. How mega cap stocks are, and even the FTSE 100 has done the last couple of years. It's done pretty well, relatively. So the demand for this market, and even the products, the inheritance tax focused products, there's likely to be far less demand from in the future. But there is an interesting article all about this in the show notes.
Okay.
It's funny when I listen to you guys, like inheritance tax seems to be driving an awful lot of stuff at the moment. Is that a fair comment, or
yes?
There's big changes.
It's front and center because the pension pots coming back into the IHT net. Okay. Carl, that's really and that's not yet happened obviously until April 2027. theoretically it might not happen. Who knows? But it's, if we stay as we are, it's going to happen. That has raised it up, back up the agenda.
Can you guys remember the stats that was mentioned at the recent Vanguard conference about, keep it simple, a couple here gets hit, assets over $1 million. I think in the US it's something like 13 million on average per state.
No, it's something like 25 million. It's something nuts.
Yeah. Let's just call it 20 million for argument's sake. So here you get caught once your assets go over $1 million, which these days, with asset inflation, properties flying, stock market flying, it's not that hard to breach that gap. Now pensions are caught within it. So the US is about 20 million. So it's more and more families just getting caught up by it, Carl.
Before 2027 rules kick in, your pension fund was just paid tax-free, is it? Or
yes. So you could have £1 million house and a £2 million pension pot. The £2 million straight to whoever you wish. Doesn't fall into the IHT net. Now that 2 million is added to the million, you're in 3 million, so you're in a whole heap of tax mess. So huge change.
The thing, and the way, and just without getting into the weeds, sorry, Carl. And the way they want the IHT settled is not for the recipients to pay the IHT. They want the life assurance. They want the pension providers to pay the IHT. So it's going to be if you've got like 4 or 5 pension pots, it's going to be a
and is that interspousal as well as to kids or just to kids?
No, it's not on first. No, you can give it to your spouse free of inheritance.
Okay,
that's down to you.
But as
that may be changed.
But I've often said and experienced it is the most hated tax of them all, most emotive, because there's a real sense, I've got to pay income tax along the way. I kind of begrudgingly get capital gains tax on I've always said capital gains tax is a tax on success, growth. Yeah. But hang on, once I've paid all this, I'm a VAT, I'm a fuel duty, I'm a blah, blah, blah. Yeah. And I've managed to squirrel away a bit, then I'm taxed again. This is what clients have told me, over the years. Is they just really dislike it.
I think what's evil about it is the way they've frozen the thresholds.
Yeah, that as well.
So a million quid estate 10 years ago, actually, you're doing pretty well.
Off.
Now in the southeast, that's. I'm not saying this to be blasé about the southeast, but that's pretty much most middle class families will have a property worth $1 million ish.
Yeah,
and already
plus
in the
net, bit of savings, bit of investments, and you're well into it.
The pensions are in the inheritance tax net here to kids. So it's funny, and we don't hear anything about it because it's always been that case. That's right.
That's right. When George Osborne, and they always were here, Carl, till George Osborne, I think about 2015, changed the rules, and out of the blue, he stood up at the box in Parliament and said, "Oh, by the way, from going forward, pension funds are no longer going to be liable to inheritance tax." And we all went, "Jesus Christ!" Yeah. And of course, the share companies of the insurance companies plummeted because everyone thought, "Well, that's the end of annuities," which was for a period of time. So he brought it in out of the blue. But we're going back to what we've had for decades and decades.
They were in, Carl, then they were out. Now they're going back in. Yeah, that's the mess.
Shaking it all about. Okay, Wodge, Brett Davidson.
Yeah, this is interesting. I'm very interested to get your views on this, but especially Alan's because he's all over this, right? So, Brett, I publicly shouting out, we should get Brett as a guest on the podcast for sure.
Totally,
because
we're all in
the guy just, I've said it before, I won't repeat myself, but brilliant stuff.
He is balking at our appearance fee, but we can haggle with him on that.
He wrote in his latest newsletter, well, the last one I read, so it's one of the very recent ones. If you haven't subscribed, FP Advance, go and subscribe to the newsletter. It's brilliant. He's arguing about tech and AI and bringing loads of different programs, software together in your practice, and those different software programs not talking to each other, and that becoming very, very difficult to scale, or even in a smaller firm, it becoming very difficult when if you've got so many different things on the go. And I know, Alan, you've sent through some stuff, which frankly is mind-boggling to me when you send it through. It is awesome. Some of the stuff you've sent through, it's you sent through a thing recently about summarize this article for me, and I'm like, oh my God, I've just this is incredible stuff. But I suppose my fear is if we start bringing these things in piecemeal, okay, as opposed to having some kind of a joined up thinking, are you just going to run your firm into do the opposite of what you're trying to do, which is, make it more efficient, streamline processes, etc. And then I suppose if that's the case, is there, because certainly, as far as I'm aware in Ireland, there's nobody, trying to put together the ideal jigsaw for a financial planning firm. So are there firms doing it? What are your thoughts on this? Should we just be embracing the tech, and if you see something cool, just bring it into your firm? It's
We'll let the
I don't think so.
Tech expert answer that. Over to you, Alan.
Yeah.
If anyone had heard our conversation before you hit record, what about holes and wires?
Nobody ever will hear about that.
Oh my God, this
This wire thing with the box that I put into my put into my laptop. Charger, Alan.
Yeah, that's it. It's. I haven't read that yet, Carl, but I endorse your comments about Brett. Every time I read his newsletters, I think he's read my mind. He really understands his market, and he's on the pace about what's going on, issues, challenges, and opportunities in our sector. So I'll certainly read that article. Yeah, it is an interesting one in that the speed at which, I've been going 21 years. I've always tried to adopt the latest sort of ideas and some of these new innovations. And it's been it's moved at a kind of glacial pace up until now. It's very, very slow and bit by bit, but things are moving and changing really quickly. But the experiences in my firm, we've kind of gone full cycle. When it comes, some of these new tools started appearing on the scene, 18 months ago. We were all over them, adopting this, trialing that. And we ended up with about 12 different pieces of tech, some of which talked to each other, some which definitely didn't. And it was a mess, really. So we have kind of consolidated. We've distilled it down. I'm not too bothered about that. Sometimes you do have to trial things, and some things which might be great, some technology might be great for one firm. Yeah. And I saw some really good technology, but in terms of the way we operate, our sort of client experience and all that is not quite right for us. So you sort of trial a few others. And we really sort of distill it all down. We kind of use 3 pieces of technology now, 3 core pieces. And one of the reasons that we even use 3, because in theory, you could just use 1 as a kind of CRM system, backbone, all the things that you're trying to do. But I'm all about trying to have best of breed. So if you try to have something that offers just everything end to end, onboarding clients, supporting clients, communications with clients, etc., then it's never going to be, each one of those is not going to be the best of breed. You understand?
Jack
so
of all
we've still
trades,
got
master of none.
Not at the moment, kind of more generalist rather than specialist. So that's why we've got 3, but we don't have 13. And I actually did a post on LinkedIn roughly about this last week, unrelated, but it's spot on in terms of your last point there, Carl, in that I just read that Uber are rolling out, the trialing self-driving cars, self-driving cabs, taxis in London Q1, I think, or Q2 next year. So there you go. An industry that's been around for 100 years, i.e. taxi drivers, is significantly under threat over the next few years. And hey, isn't this likely to happen to all of us? Well, we know it is to one degree or another. And I made the point that what we lack, there's a real opportunity now in that who's the expert in all these things? Who's going to come in and sort of effectively act as a change manager? Someone who's going to come in and say, right, Carl, what's going on in your business? How do you, how do you service clients? Right. I am an expert, or my team's an expert on all the tools and technology, and we're going to build you a bespoke tech stack, as they say, relevant to you. Because otherwise, we're doing what I'm doing. Luckily, I've got a fantastic team who's able to sort of do the research and what have you. But having some sort of independent consultant, I'm not aware of any out there. I'm sure we might get calls in the future.
What's that got to do with Uber?
Is there no? It's a fair point about Uber. I totally get the point. Like, is there a platform, designing the technology to coordinate all these activities together? Like that's I suppose my question.
There are sort of tech consultants, but there aren't I'm going to be careful what I say. There are, I suppose, some people around there. There's AI kind of and technology consultants, but they're generic. They wouldn't understand some of the very bespoke tools that exist.
And they're a bit chasing their tail at the moment as well. It's still so much innovation.
This is my point. Like, is there not a huge opportunity? Because surely this is a massive industry worldwide, and if you're running a wealth management, financial planning business, it's the same. Okay, the rules and regulations, so the buoyant piece is going to be different.
That's where it breaks down, Carl. That's where it breaks down, because if you want a one-stop tech stack,
But yes,
that's going to accommodate your compliance needs as anything. Then it's a completely different bit of software in the US than here. I mean, completely different bit. So you might as well just rewrite.
Yeah, but say note taking. Like Brett makes, if you read the article, Brett makes the point that he knows a firm who are trying to coordinate some of these things that are talking to each other. And on their own, these pieces of kit are not best in class. So they're not the best note taker. They're not whatever.
Exactly. Yeah.
But the point is, this is optimal for this firm because they all talk to each other. So look, it's very interesting, and I'd love to hear if there was firms out there or software developers out there trying to coordinate a full, like, how much would you pay for that? Like,
well,
you'd pay
I would also say that this is happening, and it's happening fast, because you've got these things. I don't even know what they are, but I've heard it's just like things that speak to each other. APIs. You've heard of APIs, and that allows you could have your best of breed, whatever it is, cash flow model, and your best of breed CRM, your best of breed if it's an AI meeting recording tool, and it's all been a bit disjointed. And again. As you know, I'm no expert, and I hear people saying, yes, I've got an API, but it's not really an API. It doesn't really work. You want this just seamless flow of data from the very first time you speak with a prospective client, and in every engagement, every aspect that you do. But what the feedback I've had literally in the last couple of weeks is, yes, that's improved quite a lot, and you can have things speaking to each other. The most important thing here, and what a lot of advisors in my experience don't do, and hands up, we haven't done this in the past, but we do it now, is to say, what the hell are we trying to achieve? Instead of looking at the latest shiny new object, or this new AI thing has started, let's buy that in, let's trial that. Let's say, well, get a blank piece of paper. What are we trying to achieve? And what are we currently using? And then sort of build out the kind of roadmap and the model on a bespoke basis for your firm. You need a tech strategy, first of all, then sort of reverse engineer the tools.
Our strategy is to wait for about a year after you've tested it, Alan, and then you'll tell me what ones to bring in and what ones not. And I kind of don't. Can I just make one point on the Uber thing, right? So, about jobs being killed that have been around for 100 years or whatever, right? So the taxi driver who knows that this is coming, right, now has endless possibilities about how to enhance his or her service, right? The taxi driver who's sitting back and going, my job is dead, right? He's no more, or she's no more. So this is the same for every single job. It's just going to allow you bring a much, much better experience to your end user. That goes for every single job and
Carl,
every single industry.
You are so right. I mean, when Uber first came to the UK and London a few years ago, I remember it well. The London Taxi Driver Association, and I'm a big fan of them. Good old London cabbie.
Sorry to be a pain. What's this got to do with financial services?
Technology.
We're just chatting, Nick.
Technology, Nick.
No, you're talking about creative Schumpeter and creative capitalism. That's fine. It's a different subject. But
Carl's, I'm just following up on Carl's point. The London Taxi Drivers Association blockaded City Hall, so they just went there and said, "Do not bring Uber in." And so they're just getting in the way of innovation. And what you can do is say, there will always be people who will prefer a human driver. I'm going to make my car the best human experience.
Just to hammer home the Uber thing. The black taxi drivers protested for this coming into London. They wanted to stop, and everyone said, "Well, what is it?" They said, "It's Uber. It's faster, cheaper, safer. You get around the city in 2 seconds." They basically highlighted all of the benefits of this new thing coming in that's going to basically put black cabs out of a job.
They hammered home their own demise. So Carl's point is spot on. Knowing this will happen, it's innovation and it's inevitable, absolutely inevitable. There's an opportunity to just carve out a different type of breed because it's going to impact everyone. It's going to impact everyone.
And where is this coming from, Nick? Just because I see you're getting very frustrated. I'm developing a point that was brought up on Trap Live and was talked about in the Q&A, whereby paraplanning is going to it's just but you got to be clued in here and you got to see it coming. If you sit back and go, "Oh Jesus, that happened," after it's happened, well then that's on you, I'm afraid.
I know, I get that. I totally get that. But the discussion point I thought was around whether you have one tech stack or a series of tech stacks, and now we've morphed into taxi services.
Yeah, we did, because that's what we do. That's how we roll.
It's called an organic conversation.
It was orgasmic. It was great. I just couldn't enjoy it. Right, moving quickly on.
Jason's
We're 25 minutes. So
Corner.
No. It's not PRSA corner. Thanks.
No, Jason's
25 minutes in, and we've done 4 points. Right, I'll be very quick with this. Jason, no, this is my bee in my bonnet. This thing about private equity, getting pension funds to pile into it here. And in the USA, Jason Zweig got this article. It's horrendous article.
You're right, Andy. It's Nick's regular update of his new boyfriend from Wall Street Journal, Jason Z.
So this fund called the Hamilton Lane Fund, it's a
JZ.
It buys private assets, buys them at a deep discount, then marks them up to net asset value and records that markup immediately in its performance figures, which to me is outstanding, sometimes resulting in the gains of 1,000% a day. It also then levies its ongoing fees on this marked up net asset value. Now, as I said before, Jason, because I might have mentioned this before, Jason Zweig is very careful in what he says, but he says, such manoeuvres are legal, but if you don't think they smell a little fishy, I suggest you make an urgent appointment with an ear, nose, and throat doctor. I'm calling it now. Maybe I won't mention it ever again. I'm calling it now. If this comes to the UK, if it comes to the USA, this will blow up, and this will blow up in retail investors' faces, and there will be an absolute cluster F. There you go.
Nick, just on that, I posted about that today because State Street, if you've heard of State Street, they are one of the largest asset management companies in the world. They publish their
custodian, aren't they?
They publish their data on private equity returns versus public markets, S&P 500, etc. So this is the first time for a while. But S&P 500, and I know it's not a fair example, but as a benchmark, S&P 500 versus the State Street Private Equity Index, which is a mix of private equity, venture capital, private credit, etc. So S&P 500 has outperformed it over 3 months, 1 year, 3 years, 5 years, and 10 years. So normal public equity markets, albeit in a period of significant growth,
very liquid, very cheap,
very liquid, very accessible to everyone, outperformed all these private equity operations over the last decade and every period in between. And the other thing that we have mentioned on this in the past, not only do we have these private market companies and become more available, we have the aforementioned Chancellor, Rachel Reeves, effectively shoehorning, telling companies and pension companies and workplace pensions in the UK that they must allocate, I think the target is 10%. 10% of their allocation. And the other thing I've said is this outperformance by the public markets has been against the backdrop of zero interest rate policy, the ZIRP era. It's very, you can borrow money for nothing and then, invest, which is where the VC markets make most of their money, supposedly leveraged equity and leveraged debt. So it is the classic rear view mirror investing right now, but done kind of on a national level. And even, there are some major institutional fund managers about to launch or have launched private equity funds.
I was going to say pretty much every single investment house is going to launch a private equity fund. If they've not already, there's brewing at the moment. Every single one of them.
And there's a big demand for it.
Every single one. They'll create the demand, Carl, because they're marketing companies, not finance companies. They're great at selling.
We are being asked.
Well said, Andrew.
I'm sure you guys are the same. Clients are asking.
Well,
so
just check out that State Street report. I know past performance no guarantee of future performance, but hey, it's an indication. If you can't outperform public markets during the best era for investing in private equity and debt, then God help you for the next 10 years. But we are just publicly stating this right now on this date, and let's all sort of revisit this in a year or 2 years.
I'd just like to say my sister works for State Street, so I'd like to just distance myself from those last comments.
State Street, they're the ones that put out the independent research. They're great. They're good.
I've met your sister who works for State Street, Carl.
You have?
Yeah,
we all have. Yeah.
What's next?
Okay, cool stuff. Well, maybe one day, Irish pension funds will be allowed to invest in private equity. Will that be a case? Will there be something in that area, Carl? Maybe that's the next point you want to talk about, or not?
Is this PRSA Corner?
Brilliant.
Maybe.
You read through the little evidence there and pulled out a very good conclusion.
Well, I was hoping for the little song, but anyway, in the absence of the little song, so this is
PRSA Corner.
My my word.
There are a million cats screaming around the country now. Listen to that.
So everyone was having a barbecue at the weekend. Nick Linker was in his boiling studio.
Singing about PRSAs.
Busting out the drop.
Nobody would believe that we've got a little song for PRSA Corner. Anyway, this is from the Central Statistics Office. And the amount of money in PRSAs at the end of 2024 was 18.3 billion, which was up 53.8% over 2023, which is massive. And the reason was that they took away those limits that I've spoken about. Anyway, I think that report is really good, actually, and it's done really well, and it's from the CSO, so it's like facts and figures. Do you know the one thing that I think about this? I think this is fabulous because most of this is from private companies, individuals, that kind of stuff. Okay.
Yeah.
I have bemoaned the fact that we weren't a nation of investors. I think PRSAs perhaps could change this dynamic, and we won't see the benefits maybe for 10, 15, 20, 25, 30 years. But please, government, please don't go meddling with something that's clearly working. Because if we become a nation of investors and we create this wealth, it just makes it better for everybody. And it's looking after ourselves. We've been so focused on looking after the multinationals. This is a little bit for the mom and pops who started their business. Just leave it alone. Let us create a little bit of family wealth, please. It's doing its thing for sure. If you create an opportunity that's fair and reasonable, this isn't unfair. This is not unreasonable. This is not tax avoidance. This is allowing people who have taken the risk all their lives to create some wealth for themselves and their families. Leave it alone. We as a nation will benefit if you leave it alone.
I'm sure they're listening, Carl. I'm sure they're listening.
Well, it'd be lovely if they would, but I think that's politicians, man. Politicians and other people's money. It's a heady mix.
Be surprised who's listening to this, by the way, Andy. You'd be very surprised.
Okay.
Right. Thank you for that latest PRSA Corner update, Carl. Appreciate that. Okay. Ultra City regulators.
So the couple of links in the show notes. One's the Times, which is a paywall. The other one is a non-paywall. So city regulators savaged by their peers for companies' compliance costs. And the boss of Nationwide spoke out about the red tape and compliance burdens. The regulator sent Nationwide, that is one of our biggest lenders, biggest banks, 4,519 letters. And I'm pretty sure they were letters, not emails, attachments. Nationwide was summoned. We get the wording there, to 488 meetings with the regulator.
Absolutely bloody ridiculous.
And there's been a report that's come out by the House of Lords, I believe. It's a 141-page report, basically saying how the regulators are they're lambasting the regulators for the inundating authorised firms with information requests. And they said that they were guilty of mission creep. There's a whole other load of stuff that it goes into, but I mean, imagine getting 4,500. There'd be so much duplicate information. They'd have to go online. They'd have to put in their nationwide regulated name, their nationwide regulated number, all the same questions again, rinse and repeat. Only because I get it from my tiny little firm. I got to, I dread to think what it's like for these super large organisations. Any questions or comments on that?
Not really. Aside from the fact, I think the regulator's going to get a bit of a shoe in this episode from various.
There was a part of a talk given by a politician. I think it was a Conservative politician a couple of weeks ago, but he was just laying out. Obviously, was talking politically against the current government, but he was laying out just a kind of anti-business sentiment. And I can't remember what the numbers were, but I think I shared it with you guys. Just the number of regulators that now exist. There's this sort of number of regulators per head count of regulated people. It's gone from, I can't remember, like 1 in 30,000 to 1 in 700. Don't quote me on that.
75 or something.
In other words, the amount of regulators hired to look after the ratio. It's not obviously. I guess the financial services industry has grown over the years, but on a pro rata basis, number of regulators versus number of people they're regulating has just, 10x over the last few years, which is fine. We want to work in a proper regulated environment that attracts investment and customers and clients. But my God, we're doing everything we can, it seems, to to regulate ourselves to death. But there we go.
Just on that following point, Nick, do you want to talk about your point now, because it sort of is connected to that?
Yeah. Thanks. I think last week or the week before, unbeknownst to us, we all got an email from the FCA saying they're going to send out a survey. My date is the 30th of June. And all the IFAs that were kind of friendly with us, WhatsApping, have you got this email? Blah, blah, blah. Well, it says that all 5,000 advice firms in the UK are going to get this email where the FCA is going to probe deeper into our businesses and ask for yet more information. Now, my one's the 30th of June. On the 30th of June, that's my company year end. On the 30th of June, I've got my compliance audit to make sure that I'm complying with the FCA regulations. On the same day, I'm going to get this survey from them. The next day, my RMAR year end, the actress formerly known as Gabriel, that is due. And I don't know, man. The FCA is sending out these mixed messages. It's saying we want to be lighter touch. We're going to be more kind of what was it, rules based? I can't remember, or whatever. They're going to lay back on what the information they're asking from. Oh, and of course, in the meantime, I'll probably get a baseline resource email about my finances, because God forbid values division goes to the wall. It'll just be another 2007 to 9, won't it? In this part of the world. So yeah, if you've got this email and you're thinking they're targeting you, they're not. Every poor sod is going to get these emails, and then they're going to do targeted follow-ups depending on the responses. So be anodyne, stick in the middle, right? Don't go too fast, don't go too slow.
We did see an example spreadsheet by another financial advisor who shared something that he thought is the most likely things that they're going to ask. It's a lot of detail, but if you're, on top of your business, on top of your numbers, on top of your MI, you've got 12 weeks to fill it in. I'm hoping me and you, Nick, can do this very quickly. If tiny firms
I could probably do it in an hour of getting it. I do my RMAR in a couple of hours.
Have got no grasp of their data, MI, got all these different people.
My point is, why do they need this information? They've probably got a lot of it anyway through our reg data return.
So much duplication.
They won't even look at it, and still see the crooks will still be doing their shit.
Yeah,
they don't give a damn.
Agree. This is the point. I spoke with Shireen in my team about this. Have we received it? Yeah, we've got it. She said that we'll do it, obviously, but she said the frustrating thing is we already supply a lot of this. I've looked at the spreadsheet. We already supply a lot of this is in the RMAR.
85% of it. 85%.
And no one minds providing, but you always wonder what happens to the data that goes into the RMAR return, because if they've already got that and they're asking for it again through a different medium, it's frustrating anyway. But
and then they introduced that other one that was just a temporary thing during COVID that we all complied with, and then they've continued to do it. It's all more duplication. This is what Debbie Crosby, the chief executive of Nationwide, she said the things that they asked for are extremely resource intensive, and there's no optionality with this. This is, we need this by next Friday. We need this by the end of May. We need this by the end of October. It's just,
remember, Carl, what I told you years ago about compliance. It's always going to come at us, and you can use it as a positive, because the good firms, like all of us, we just through gritted teeth, we deliver on it. Of course, we give it to them as soon as they want it. And others might struggle. It's just you use it as a potential benefit. It's the only way I can get my head around it and look at it as a positive thing. It's
without crying.
It's well framed, but it still doesn't change the situation.
Okay, right. Let's move on. So, Smithy, back to your
well, now we've got
latest.
We've got
shiny
Crypto Corner. I think this is relevant to all advisors out there. The latest, the kind of the emerging asset class, which we generically call, I know that Carl's going to get excited on this, Crypto Carl, but call it crypto investment, particularly around Bitcoin. As I've said, when we had a whole episode on it, it's a $2 trillion asset class. It's growing at a major pace. Looks like it's becoming more mainstream, being taken up by sovereign nations now, as well as huge wealth funds, etc. And the UK has been dragging its heels somewhat. But breaking news last Friday, or the Friday before, the FCA announced that they're beginning a consultation period in theory, to allow retail investors access to what they're calling crypto ETNs. I didn't even know what an ETN was. Yeah, but okay, what is it?
Yeah.
Smart Alec. What is an exchange traded note?
Well, it's similar to an ETF, but you can hold completely random stuff in it. You can make you can hold art in it, you can hold wine in it, you can hold oil in it, you can hold loads of stuff.
It's a debt instrument that you don't actually have to own the underlying asset. But that's so.
Well, synthetic,
anyway,
yeah.
Oh, so it's like a loan note?
No, I don't think so. I think it just
it's a debt instrument.
It effectively it tracks
like a loan
the.
note. Because they've always worked.
But hang on. Here's the thing that again, I'm no compliance regulatory expert, but the assumption is that will get signed off and approved as being potentially viable for retail investors, right? So I see this as a couple of points, regardless of your view. Doesn't matter what your view is. There's a couple of things. One, that allows your clients potentially, or future prospective clients, to go and buy it. If they say, "I know, Carl, you're not interested. I quite like the idea of this thing. I'm going to go and buy it." And they could end up blowing themselves up because there's good, bad, and indifferent across in that space.
Financially blowing themselves up, just so we confirm.
So, again, just washing your hands and saying, I know nothing about it, not interested in it, is a risk. But the other thing is in the UK, as you know, we are expected, if we are, and the three of us are, independent whole of market in terms of the regulatory status. So we are expected to review and analyze this. We will expect it to consider in the same way as we review and consider structured notes and everything in theory. In other words, you're going to have in future you're going to have to document
VCTs,
you're going to have to document the reason why you don't.
Well, we apparently are obliged to consider structured products and then obviously disregard them because they stink. Structured notes, ETNs, are they not in? And I'm just showing my ignorance here. Are they classified as pooled funds? Because to me, they smack of individual securities, and we definitely can't touch those with the box.
Don't know. But this is the point being. This is
not quite individually.
It's not individual.
It's not individual.
It's collectives. It's pooled.
No.
Well, the point being here, Nick, they will be available for retail. Well, assuming it's a consultation, but it's a quick consultation because it will close by July.
No.
And the chances are they will roll these things out, and that's a precursor to eventually creating ETFs and allowing the likes of BlackRock and others to launch ETFs. I know for sure, and some of you on this call also do, that there's a pent-up demand for access to some of these asset classes within your pension fund, your ISA, and everything else, which you can't at the moment. So I've said it before, and I'll say it again. As you know, we at Capital, Dan Parkinson, which we spoke about before, ran a Bitcoin workshop. He's still offering them. And I think we can't ignore it. And it's absolutely fine to say, not for us, not interested. It's a lot of, it's wizards and clouds, however you want to describe it. But we're all running out of excuses to say it's not regulated, so I don't know anything about it.
Yeah, I get that. Okay. If that's the case. Okay.
Can I just make a point on that, right? I hear you loud and clear, right? And I have clients asking us, we have clients asking us as to how we would go about doing it. So 100% there's a demand for it out there, right? I've said this privately in our group, right? Now, if they make these into ETFs, right, that advisors can basically go and flog, watch them all. Watch some of them, the bad actors, ditch their investment philosophies overnight because they'll chase the money. And I have a serious problem with that. Like, do I have a problem with the client coming and saying, in my playpen, I would like to purchase some Bitcoin. Can you facilitate, or can you tell me how I would do that?
Yeah, that's fair.
Yeah,
no problem
totally.
whatsoever. But I just think that this is going to open up a whole world of people just chasing all your pension into Bitcoin.
It's ever been thus, and there's always a bandwagon and a theme, and some will be extreme in it. Yeah, you're right.
Hopefully it wouldn't be. It's a massive shift to go from the totally evidence-based kind of approach where we've like methodically looked at investments over the last 20 years but I can see like I'm not shitting on these people, but maybe the more active fund picking kind of IFAs, I can see them kind of becoming more bandwagon. I'd be amazed if an EBI
and frankly, Nick, the younger folks coming through, they think we're dinosaurs. They think I'm a dinosaur for sure because some of them have said it to me, right? But and they just think it's Bitcoin all the way, and that's it. And I'm like, that's on you, my friend. What has always worked will continue to work. and playpens are fine.
The devil is in the detail. I mean, the article title, FCA lifts ban on crypto trackers in growth push. And then in the first line is poised to lift. So obviously they're just making an assumption. We don't know exactly what crypto assets they're going to allow. I mean, the obvious one that they're going to allow is, the first one they're going to allow is Bitcoin, a Bitcoin ETN. And then after that, who knows whether they're going to go a basket of crypto.
Stable coin or something like that. So look, the point is, this article is, if the ban isn't lifted now, that's coming. That's exactly like driverless taxis. Yeah. It's just coming. It will come. So,
agree.
If you're, get ready for that too.
But there is still there is a shed load of way you can access crypto and Bitcoin assets in the UK at the moment. Various different platforms do things. Yeah. So if you're that motivated to have exposure to it, you'd already have exposure to it. This is the mass market offering now.
Yeah. Fair point.
Is the mass market offering now.
All right, gents. Right, we're at 45 minutes in. We've still got 4 or 5 points to go. So, Wodge, Solar 21.
Yeah, I'll fly through this. So this is this. We had a laugh about this. The I call it a solar wind farm, but you know what I mean. It was this solar investment that was going pear-shaped, and there's various tranches in this. And this article, I do you remember way back? The promoters of this thing were saying, "Oh, stick with us, and we'll figure it out," and blah 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 blah. Well, they've just announced that certainly one part of it, or one plant that they had, which is actually in the UK, went on fire, and unfortunately it's going to have to be sold on an insolvent basis. Now, the article headline says that it's the older pension investors are going to be mostly affected. I don't know why they said that, other than that's probably just grabbing headlines and making it a little bit sensational. But the point here is, I had said at the time, these things, when they've gone pear-shaped, you're not getting your money back, or you're going to get very little back. It seems that this might be now playing out. Unregulated investments like this, just be very wary of what you're getting into.
It's always a recurring theme, isn't it? It's just a recurring theme. Thank you, Carl, for updating us on that one. Ultra mortgage rules.
Yeah, this one is, I think, quite interesting. Obviously, debt is a huge thing for lots of people, buying houses, trading up, etc. The FCA have proposed a couple of changes in relation to this. 3 points to this. They want to make... Sorry?
Profound.
They want to make remortgaging to a new lender easier. So currently, lenders undertake a full affordability assessment when taking on a new customer. Our proposals will allow them to do a lighter touch assessment if the mortgage offered is cheaper than what they're currently paying. So if I'm paying $1,000 at the moment, I'm going to go for another lender, it's $900. They'll do a seamless way for me to do a remortgage, just checking my credit score and then switching me over, which will add a lot of innovation to the mortgage market. They also want to make it easier for you to reduce the amount that you totally pay back, where you can reduce your term. Currently, if you've got a term of 20 years left and you say, look, I've worked it out, I can pay it over 18 years, they do a full assessment, full hard credit check. It's a freaking nightmare. So they're going to introduce that to basically make that lighter touch. So they're just introducing things which make common sense in a heavily regulated market. So. So some good innovation coming down the line in relation to lightening up some of the mortgage rules. Nicholas
has a quick anecdote around property. I was speaking to a client this morning who's got his second property on the Isle of Wight, and they're going to bump up council tax on second properties. I don't know
how much is it. Is it a massive amount, 100% or not?
I don't know the ins and outs, but it's more money. But he was saying, if you put your property on your second property on the market, that doesn't apply. There's a massive bit of there's some games to be played there. There's some money to be made there. What a ridiculous loophole! I mean, just put your house on the market and just leave it there for 10 years.
Just always in the market.
I'm selling. I'm selling. Yeah. Okay.
Yeah. It's just
about these games.
By the way, and it's devising stuff.
So half the Isle of Wight is going to be on the market the whole time. It's like Roy Sullivan's dream.
Well, I'll finish it. There are 147,000 people, I think, or properties or people on the Isle of Wight. Yeah. There are 106 properties listed at more than £1 million on the Isle of Wight. So they're just listing and obviously putting out stupid prices, and they'll just be listed for years to come.
And there's an estate agent in the Isle of Wight who's never actually sold a property.
Yeah, but he's coining it.
But he's a lovely website.
Call it Split the Difference PLC.
We should come back on this whole thing about manipulating the mortgage market and all that. That's a whole other conversation. We don't do a lot of it. But the Help to Buy scheme. You any thoughts? Yeah,
think about bringing it back.
But it's
still
gone.
going,
And I
still
just
going
spoke
belly up,
to
isn't it?
Yeah.
Who
spoke
could
to
have
a
seen
couple
that
of people
happen?
recently.
Shared
It shouldn't
ownership.
be called Help to Buy.
Shared
It should be
ownership.
called Help to Sell, because all the developers and they built all these incredible houses. I was speaking to someone the other day who was just looking to sell his property in there's a lot of these developments down at Canary Wharf, all these fancy penthouse apartments and so on.
Yeah.
And then they built a whole lot of new ones under this Help to Buy scheme. So all the developers pump the prices up because buyers are going to. And if you had one of the existing properties across the road, you were at a loss. So because the builders, the people, you can't sell them nowadays. Basically, the thing, all roads lead back to this. It's not just another moan. It's just all about. It seems that people in power don't seem to understand the power of incentives and look at second order effects. To do one thing, we want to help first-time buyers. Good idea, brilliant. So we're just going to do this one thing without thinking, if that happens, then this is going to happen, then this other thing. Like the Isle of Wight estate agent, like the Help to Buy, Help to Sell. It's nuts.
Well, even that, Alan, I pull back on first principles. It's not the government's role to help first-time buyers.
Yeah.
What are they doing? Even that's wrong. But that's just because I'm more libertarian, I suppose. But they just have no idea. They do not understand human nature. They just don't see it. It's just bizarre. They have this massive blind spot in these kind of things. Okay. Well, Ultra, that was a more interesting point than I thought it could ever be on mortgage rules. Thank you very much for that. I've got a plane going by. I'm close to Elstree Studio.
That wasn't condescending at all.
Let that go by. No, it's genuine.
It's because he got to tell his story. That's why he's pleased with it. Exactly.
Viceroy made it interesting. If you want me to be honest about it, that was it was a bit shit, and I made it better. Okay, the three of us, not Wodge, because he just dips his toe in when he wants to these days. Really, he's part time. But the three of us went to an event recently at Vanguard at the Frameless. At Frameless, the building's called Frameless in next on Marble Arch, top of Hyde Park.
Was I invited to that? Was I invited to that?
Yeah, your email's in your spam folder. Get one of your lackeys to show you where the spam folder is, mate.
Right, okay.
BBS,
we went to the Vanguard event. Very good. Vanguard are sort of we're developing things with Vanguard in terms of the trap proposition and stuff we can do for the trappists, and that'll emerge over the next year or so if we can get something organised. But it was Smithy? What did you think of the event?
I thought it was great. I just find this quite interesting. How events, we've talked about events in the past, but it's like we've begun to up our game, or the profession, the industry. We spoke last time about the Advisor 3.0, which was just like kind of mind blowing in a way. And the Vanguard event, it was held. If anyone's ever been to it, obviously as a keen art aficionado myself, a keen collector of art, it was held in an art gallery.
Oh shit!
And it's but I have actually been to that art gallery. I have in the past before. And it's like, of course I
have. Jesus Christ.
He opened it.
He opened it. Yeah, he did open it.
Tenerife. I've been to 11. It's a very interesting, very cool venue, isn't it? It's this kind of whatever you call it, 3D art. I just love the setup, the venue. As you would expect from Vanguard, it was run extremely well. We all went, you go into these, I thought it was quite funny. We all sat down the front row every time. So we sat in front row with the CEO of Vanguard, or one of the sort of top dogs of Vanguard UK, Europe, I think, who was kind of interviewing the global CEO of Vanguard. Yeah,
big league artists.
Now he asked my question as well. Actually, whilst we're doing this, I do need to give a shout out to that UK top dog. His name's Doug Bennett, and I met him recently, and I think he's only young. He's only like 39 or something, but he's a big, proper boss, serious person. And he said to me, I hope he won't mind me sharing this publicly. If he does, I'm sorry. But he said that he's a massive trap fan. He said he lives down in Devon, and he gets a really sort of early morning train. He said, I always look forward to tuning in to Trap. I thought, oh my God, you've got these like serious people, really top dog business people listening to our gibberish. But no, he's great. I've met him a couple of times. Really good. And so the whole experience, I thought it was really well organized, really well done, and the content, the things that I don't normally warm to, which is like in-depth analysis of the market by economists. They had their global chief economist there, and I thought I loved it. I thought he was just I followed it.
Because you thought he was talking at your level,
be way above my level, but he was actually, he was talking at a level that I actually understood, and I thought it was really smart and insightful. So, and of course, and the last thing I'll say is just a
I leave you guys alone. I leave you alone for one event, and you're now loving global economists. Oh my God!
Hold on, well, don't label me with that. I thought that was the weakest part of the whole
I thought it was really good.
I happily gone off to sleep.
He did say some good stuff. I've actually got his book here, isn't it? Am I confusing my Global Economist?
We've all got that. I want to read that and look at it next time.
Coming into view.
I didn't get it. I didn't take a freebie. I did not take a book written by an economist at this event. Just for the
Nick, I've got two, mate. You can have one.
No. You keep scribbling the other one. You won't stay with the pictures. You're doing well. Right.
The other thing that I would just say about these conferences in general is there were, again, stating the obvious, that I had so many just kind of off-the-cuff conversations, kind of classic round the coffee and all that. Bumped into people I hadn't seen in years, and a few other interesting things just spun out from it. So as I always say, show up to conferences, just go along, choose them carefully. Don't go to every one, but go there with the intention of just bumping and having informal conversations with people, because you never know where it's going to lead to. So I thoroughly enjoyed the day and the evening. Hey, Nick.
Yeah, it was good. Yeah, when they invited us to this very nice lunch, I was sat next to the behavioural guy who earlier on had, in a very fluid way, jumped onto stage and explained their latest advisor asset. Nice, lovely guy from Brazil, married to a Texas chap. Interesting guy, lives in Pennsylvania near the Vanguard complex, which is sprawling there. Now they've got so many employees. And the advisor alpha, this is a big thing with Vanguard. And I think for me, that's the bit I like. It's really, again, younger advisors, check out Vanguard. Just Google Vanguard Advisor Alpha. They've got a whole library of stuff there to help explain to clients where the value add is, or where it should be in your service offering to your clients. And he said this thing about, in the research, clients don't generally feel positive about their relationship with their advisor. They don't feel glowing. They don't feel comfortable with investments. Where the value is with clients, of advisors, is the advised clients just feel less anxious. Now, that might sound as being the same thing as being positive about their investments. It's not quite the same thing. But that's the takeaway. Clients don't come out of our meetings just saying, "Oh, Nick, I want to hug you, and it's the best thing ever." We're giving peace of mind. And if we can help people just be less anxious and make fewer silly, irrational decisions, then that, to me, is the job done. And that's a big part of the Advisor Alpha takeaway.
Just on the Advisor Alpha, Nick. The latest one currently, I think, came out in 2020, and we did cover it in the show. They've got a new one coming out, and I know we spoke about it at the event, but I can't find it online yet. But when it does launch, the 2025 one, and it's public for advisors, we'll have a little bit of a feature of it on the show, if that makes sense. So I don't think the new one's out yet.
Okay, cool. And just a shout out to Nicola Constantino, who's our contact point at Vanguard. Thank you, Nicola. We all really enjoyed the day, and we're looking forward to working together over the coming 12 months, although your view might change of us in 12 months' time. Okay, let's move on to, what are we at? Jesus, 57 minutes. Let's move on to the meat and potatoes of this show. And this one is, we haven't done the subject before, I don't think. No, we haven't. You might know, dear Trappists, you might not know, but I set up this online forum, a Google group, tiny.cc/IFA forum. It's got about 800 members now. Can get very noisy. Those that love it, love it. Those that can't take the emails, leave it. Up to you. But there was a thread doing the rounds 2 or 3 days ago, and it's about a 30 contributor long thread around compliance support services. I'm not sure what you call them in Ireland, Carly, or even if you have the equivalent.
I'd say compliance support services, yeah.
Okay, fine. And there's one called Simply Biz in the UK, and on the forum, they're getting a bit of a shoe-in. Apparently, they're raising their costs by sort of 20% without even telling anybody. It's just happening, and other firms said, no, they raised ours by 30%, but if you go back to them, they'll immediately drop it down to 15%. But loads of IFAs are leaving Simply Biz. And Simply Biz, I wouldn't surprise me if it's still the biggest compliance support. It's certainly up there as one of the biggest in the UK, but wasn't a good look for them in this IFA forum. And so lots of IFAs are leaving Simply Biz. And that got me thinking, and I think based on experiences we had recently where we met somebody who's looking to become an IFA. And they have tried to do it the directly authorised route, and it's really, really, really difficult. And he and or maybe even a she, they're doing it through a network.
Oh, go on,
you got a problem with that. 16 million people in the country. What have I given away, Bella?
No.
Yeah, thank you. So he and she, and maybe both of them, maybe they're
God, come on.
They are going to use a network. Well, right, you continue. I'll give up. Go on, you continue.
Oh my God, Nick. Andy was interrupting me. Carry on with the story because I was there in the conversation. Please carry on.
Yeah. Right, okay. And so this person is going to use a network because it's the only way they can get authorised. So it brings up this thing now of if you're with a compliance support service that you're not happy with, do you leave? Which you can do. I did. I mean, I left Simply Biz 3 years ago because I just felt they were offering me a service that aligned with my business. They were offering me loads of stuff I didn't want, and they still seem to view me as a broker, as opposed to a financial planner. So I went out. I left them. I've always been directly authorised, but I changed my CSS, and now I use the compliance department, who are great, very pared down, just provide me with compliance. That's all I want. But that's one subject. Which are the decent compliance support services in the UK? I don't know. I know there's some decent brands, but I don't use them. But maybe you guys can help. But then, should you consider just going the network route anyway? Because there's a lot of conjecture out there. The FCA wants most small IFA firms to join networks because it's far easier for them to prod and push a network than it is to prod, X number of one-man band IFAs. Andrew, you've got your hand raised.
Yeah, I'll just run a couple of points. I'm a current Simply Biz member, and I've received those emails every year, just jacking up the prices with no explanation. I'm sort of just too busy elsewhere and pick your battle, so I just, accept it, as it were. They help me with reg data quite a lot. So I've got, support, my accountant and Simply Biz help me with that. And they do an annual compliance visit where they, rip up the floorboards and go through everything. So I'm sort of happy with what I'm paying them. They do nudge it up every year. But in answer to your point, if you were setting up a new business today, it's a lot tougher than when Nick went DA in 2008, Nick, sorry. And when I went DA in 2017, we've heard from a lot of very experienced, very clued up, very technical advisors, it's very hard to do. I think I've heard anecdotally, again, I could be out with the numbers, about 10% of people get accepted to go directly authorised, and it's an extremely excruciating process. You fail along the journey, but they don't tell you the reasons why. You then reapply, you fail another part, they don't tell you the reasons why. It can be quite messy. But Simply Biz, in that article I shared that we may be able to share in the show notes, Simply Biz said that out of the people they hold their hands still to become directly authorised, they've got a hit rate of 90%. So if people are thinking about going directly authorised, then it still is a valuable option to pursue via Simply Biz, because obviously they've been there, done it with hundreds, maybe thousands of firms. My final other point is I hear very good things about CATS. So if I was to switch my compliance services company, or whatever you call it, CSS, I'd consider to go to CATS. I know loads of firms that use them. I know the founders quite well. Verve is another one that we've spoken about quite a lot. And then obviously we've got 360, which I think, Alan, you're maybe part of. 360 and Simply Biz now are owned by the same company, Fintel. I'm pretty sure that's correct. So they've had a bit of a roll up in that space. And my final point about Simply Biz is, they are owned by Fintel now, which is a public company, very keen on growth. So maybe fees on the rise is the direction they're heading. Who's next?
Well, you've taken most of my points anyway. I think that to me was
standard
quite important, in that this is a classic model, isn't it? You do a roll up. And Fintel, who we have spoken about before, well, you spoke about the person that founded, I think, Simply Biz, when it was called DBS, who
moving on from more.
Sir Ken Davey, wish you well, Sir Ken, long and happy life. So Fintel doing this roll up, buying these companies, and that's what you do. You don't just buy a company, let it sit. What you do is you squeeze the juice, don't you? And that's what's that's.
Oh, you mean CATS might be next, Alan?
CATS, but they did acquire 360, who we use and have used for many years. 360 historically, they were independent, then they sold, and they were bought by Aberdeen. Now they've been sold again to Fintel. It's just a changing shape, and of course, the great thing about kind of free markets is if people don't like it and don't value it, they no longer pay, and they give notice, and that's clearly what's happening. Looking at the email group, Nick, that's quite a lot of people are exiting and looking.
Sorry, just coming on that point there. In that email chain, there's one guy who every 6 months gives notice to Simply Biz. They haven't raised their prices with him in years.
Yeah, that's right.
I mean,
but it's like Sky, isn't it? You ring up Sky, threatening
it's like
the 3 months, and they
like the
give
estate
deal.
It's just gaming the system, isn't it? It's nuts.
I know.
Yeah,
but you're
time, though.
You're right. We know a few, and one in particular that I met recently. Top people and firm who applied for direct authorization. You get interviewed by the FCA. You need to know your onions about things like senior managers regime, really deep in the weeds kind of stuff about this. And it's quite tricky to know that. So as you say, I'm not surprised at those numbers if 90% get rejected. So therefore, well, there's two things. One is a network, and then there's compliance. I guess if you join a network, you get all that bundled in. And if you are DA, you go to it, you generally need, like we have, some sort of compliance support services. I would say I've just used 360, as I said, for years. We're okay. We're absolutely okay. We run Shireen in particular and the team run a very tight ship around compliance and reporting, regulatory stuff, but it's quite useful to have sort of an independent third party. What I also know, because I still have to keep up to date with all the kind of regulatory rules, and 360 provide online testing and all that stuff, just in one sort of simplified. It's just if you have to do that yourself or create your own model, it would be a disaster. So it is absolutely useful. The one name that was new to me for the firms, because we all know I've taken loads of calls from advisors, maybe leaving bigger companies looking to set up by themselves, and they've got that option: do I go DA? Do I get support from a network? If the latter, then who do I use? But a name that we heard recently, I think you guys were in the conversation, was New Leaf. Heard of them? Never heard of them before. Yeah, you heard of them. So someone who'd done a lot of research, and again, do your own research. I have no clue, no idea. But there's a range, obviously, of all these actual networks you join, which is again slightly separate from compliance support, like CATS. So they're probably worth putting on your list if you're doing some research. New Leaf.
Just the other two to mention that I know quite a few advisors use them. Sense, and then the other one is Valid Path. I believe Valid Path, in the space of like a month, doubled their business. They were basically looking after 100 firms, and 100 new firms applied. So within 3 months, they had 200 firms under their wing. So they are growing at a major clip, because DA must be so hard to do. So if I had to go DA today, I may or may not pass the test, so I may end up having to go with one of those networks.
The stat I heard was that the FCA taking 3 months just to look at DA application. I mean, that's...
Yeah, I know. Can you imagine?
If the roles were reversed, treating customers fairly, and we said, no, well, I'll come back to your email wanting money out your pension in 3 months' time, love. I think I might have been in a bit of trouble. I would just say about you mentioned the exams of 160 and that kind of stuff.
Sorry.
I left Simply Biz because...
you said you called them 160.
Go on. Stop interrupting me.
Whatever. They're discounted.
Nick, speak. Stop interrupting me now.
I left Simply Biz, and I was nervous about the fact I'd be losing kind of this great big support thing. But actually, you can, if you're a one-man band, you can do the RMAI by yourself. You don't need help. It's not that. Once you realise how stupid it is and where the stupid bits are, you can link the stupid bits together.
Sorry, Nick. Reg data. I know. It's just a.
Yeah, CISI or the PFS will have all the learning modules for you to do. You don't need a compliance network or compliance support provider to give you that. You can do that on your own. And I just wanted a lean, mean compliance machine that would come in and audit me once a year and then give me updates through the year. And that's exactly what I've got with the compliance department at a fraction of the cost. So, Andrew, you're busy. You've got lots going on. You're selling your software and stuff like that. I appreciate what there's stasis for you with Simply Biz.
He's not selling. He's just training.
Exactly.
He's a software
trainer. For anyone
trainer.
else at the time, I would do it.
He's up down the country.
Oh, sorry, you've changed the terminology. I thought it was a software salesman. That was your terminology.
Just whatever.
I love the little needles going in. It's not the same here. There are no Simply Bizes or Verve or any of those. The market here, I think, has a couple of kind of consultants who do this, but not absolutely tons. When I set out my own, I employed Evelyn Hanrahan of Compliance, Governance and Training, and she went through the process with me, and I know she's still doing that very successfully. And Evelyn then acted as our kind of a consultant to the business for compliance for several years, until such time as Sinead Clinton joined, and then Sinead took over as compliance manager. And what we did then was Evelyn kind of worked hand in glove, I suppose, with Sinead, and Sinead is now head of compliance. there are maybe, if you wanted one-off project works, there's kind of legal firms who'll do that for you. But there are no firms in Ireland like Simply Biz. Brokers Ireland would kind of represent a large portion of the broker market here, and they would give some compliance support, but not like Simply Biz as you guys are describing it, I think. Nick.
Okay, Andy, take hand. My question. So, but you're relatively Metis Norway is quite a big organisation. What about the one man bands in Ireland? How do they get? How do they get their compliance information? They just digest what the regulator throws at them and then make sure they adapt to it. Because here, it's just like the rule book is like 10,000 pages long. It's just like no chance.
Yeah, is there a lot of solo advisors in Ireland, Carl? Like, as a hazard a guess of a percentage, what would you?
So you could be hitting the nail on the head here. Yes, there are. Way too many, I would say. How they all comply with the regulations that we comply with is hard to fathom. But they must just work a lot of hours in the evening, that kind of stuff.
Winning the pop
I better stop
popularity
talking. Carl,
competition again amongst the Irish advisors.
He's a broken man.
No, there's honestly, there's a lot I could say, and I'm not going to say because I just get myself in too much trouble. But it's
No, keep talking, Carl. Keep talking.
I won't. I saw one of the questions that we're going to address now shortly, and I'll get myself in enough trouble with.
I've just done a quick Google search, Carl. I found the complianceconsultants.ie. They look like they do something like this. Paula Downey, founder of the Compliance Consultants. Anyway, okay.
Yeah.
Cool.
I know she's very well regarded, I would say. My only experiences with Evelyn, and I thought she was fantastic. So compliance, governance and training, I would say is my only experience. So that's all I can tell you. But sure. I know there are other consultants out there. I don't know about that first one that you called out, but I'm going to guess that that's probably a 1 or 2 man show of some description,
cool.
Which is fine.
It's a big thing here. Yeah, Simply Biz look after about 3,000 firms in some capacity, I believe. But again, I don't know how many.
They increased their prices by 15%, and they might lose like 3% of their clients. Yeah. It makes no difference to them. They've done the maths on this. This is of course. Like,
and if a few people ring up and kick and scream, then they'll just, make an adjustment.
I think a lot of it is lethargy, and people just they know what they know, and they're scared to leave the embrace of their current CSS. It's
I can imagine how much hassle it would be if you've outsourced this and to change your provider.
Yeah, but
Jesus, life's way too short.
I mean, I've been with them since 2017. I had the same person looking after me until just last year. So I've had my regular consultant for the first, 7, 8 years.
I think anyway, a lot of this as well. Yeah, price is relevant, but it's not the number one reason you choose. I think it is cultural, Nick. So as you say, if you've got a compliance company that's really all about, helping a broker become compliant, how do you sell pensions and still tick the compliance boxes versus a more consultative relationship, looking at what's over the horizon? I think Andy, you mentioned CATS, which is Mel Holman, who would know, but compliance and training. So the good firms
look after the
and I know some
firms.
People, for example, they used God, he just interrupts again.
Financial planning. Simply Biz doesn't really get financial planning. Sorry.
But some people will use, for example, a 360, which is kind of a big institutional type thing. But you got big websites and training programs and stuff, but they want a bit more of a, an individual or someone who's come in, have a chat about, the business and life. So they will use, and obviously some people will just use CATS by themselves. We've sort of spoken with Mel and her team quite a few times, but of all the companies, you just hear general feedback. I've always heard 100% positive feedback about them. So, do your own research. We've given quite a few names in there based on our anecdotal experience and real life experience. But it's a fast moving game, actually. I think there's more and more new firms. I'm hearing more and more startup, 2 or 3 people, advisors, going to start my own company now. The world is changing. The focus on full fat financial planning is becoming more and more important to a certain group of people. They no longer want to work for some of the big, discretionary managers and what have you. So they need a seamless entry into their own firm as possible. DA looks to be a real challenge. So how can you do it? So hopefully we're giving some ideas.
Buy a firm. Buy somebody. Sure. It might be an easier way altogether if the failure rate is 90%.
Just to mention them again, Verve. We're huge fanboys of them. I mean, they seem to be covering everything off. So they've got their incubator where you can go in as a potential DA firm. They'll hold your hand, do it. Once you've done that, then they've got power planning services. They've got compliance services. So they seem to be doing some great things. And Kathy,
I was just about to say to that,
the Vanguard event last week and had a good catch up there.
I've had
celebrated a
communication
10-year
with
anniversary.
Kathy. I'd never actually met her in person until that Vanguard. It was great to meet her. She was doing a kind of panel talk as well. So we met with Kathy, and she's great. But yes, they do a lot of stuff. So that's another reason why you might want to engage, because they do a lot of coaching, counseling, mentoring for people. So it's one thing just getting compliance support, but how are you going to grow your business? How are you going to recruit, hire, all that good thing. So, and she said, she didn't give me the details, that they are planning to launch something else very new and exciting and innovative for the business quite soon. So, yeah, she'd be a great guest, show. Actually. Yeah, absolutely.
Yeah, let's get her on the show.
Kathy, if you're listening, get in touch.
Contact
Come on the show.
Kathy.
Okay, we better close this off. That was quite a good, if somewhat heated discussion. I think the takeaway that I took from this is that if you're with a CSS and you're not particularly happy with them, and it's not all about cost, Alan, it's about value, but if you think they're taking the piss, push back a little bit. And if you're thinking about leaving your CSS, you can do it. And if you're a newbie, I think you're probably, based on how the FCA is working presently, you're probably going to be forced to go down the network route initially, perhaps. Networks are certainly more respectable now than they were, say, 20, 30, 40 years ago, when it was all about commission overrides and all that kind of stuff, which is in the past. Although, I think we might have a Trappist question that wants to bring the past back into the present. So let's move on to that section of the show. There she is at my front door, lugging the bulging sack up the drive of the Trappist questions. If you want to leave a question for the Trap Pack to answer, please do so on the pinned tweet on X or the pinned X on tweet. We're now up to questions from November last year, so we are getting through them, but there's still quite a few in the hopper. We will get to them, unless you're trying to promote web design services, as someone was recently on one of the questions for our YouTube channel. Thank you for that, the chap from Bangalore. That went straight into the bin. Okay, let's open up this first question here and see who it is from. This is from... friend of the show. We all know him. The mighty Quinn, the Quinnmeister. Dave Quinn, who's on Twitter as @InvestWiseFP, Foxtrot Papa. Carl, I think you'll have to take this one. Right, following Carl's comments on the Irish commission-based system, I wonder how many firms in the UK would like RDR reversed now and commission reintroduced. There is some pretty heated debate on LinkedIn between Irish advisors at the moment on the merits of commission-based remuneration. Carl, you've never expressed any view on the commission-based system. What are your views on it?
Dave is part of the Ideas Exchange with me, and he's a great guy, Dave, and he's very forward-thinking, and he knows he's just throwing that grenade.
I know Dave
he knows
as well.
I won't be able to resist. Yeah. So, Dave, thanks, buddy. There is a lot of heated debate because the guys and gals who are after the commission want to protect that. There's perhaps some evidence that there's a little bit of consolidation going on in the Irish market that is gathering assets.
Go on, Carl. Go on.
So that commission can be paid on those assets, perhaps, maybe over the next few years. If you have a model in a country, any country, it doesn't matter where it is, whereby you pay 5% upfront commission on a transfer of a pension fund, and then you lock that pension fund in with 5-year exit penalties. But lo and behold,
the power of the dark side.
Lo and behold, after those exit penalties expire, there's a new reason to change your provider.
Really?
The client gets screwed.
Yeah. Okay.
End of story.
Thank you, Carl. I'll quickly leap in this. I'm sure I can talk for the two of you, but disabuse me if I'm wrong. I would not want to see RDR reversed. RDR was just one of the really good regulatory things that's come in the last 20 years or so.
What I do know, I'm old enough to have gone through, although I wasn't an advisor at the time, but if you go way back, I can't remember when it was, we had commission disclosure was brought in before, never mind about fees. You didn't used to have to tell the client how much you earned.
It did.
So, And I remember people saying, I was working at Standard Life in those days, my IFAs, my brokers were saying, oh my God, it's the end of business. If my client actually finds out what I'm going to earn, Jesus Christ, it's all over. But of course, it's not. And people, then you have to up your game. You've got to deliver value. And then fast forward to RDR, and fees effectively replace commission. And there's lots of gaming the system going on pre that, like you're talking about now, Carl. If you sort of locked money into an investment bond, and then it would just, a trail commission would carry on until you made a change to it. And
so a firm in Ireland, Alan, right, who's got 20 or 30 million of assets. Why do all the financial advisors I know drive Range Rovers? A client of mine said that to me, right? Because some of them, there's the same money being churned over and churned over and churned over. And here,
a classic sale was the life assurance bond. Exactly 5 year thing. In fact, never mind 5%. They used to get paid 8%. Certain companies paid 8% up front, got all that money, and in 5 years, we've reviewed your bond, and there's this other plan down the road that's got a few more funds. So in order for more fund options, we're going to move it, take the 8% again. It was just a cycle ongoing. So most of that has now gone, I'd like to say. So yeah, it's inevitable. There'll be winners and losers in this, but the winners will be ultimately the customers in the profession. And guess what? We actually get really nice people reaching out to us now because it's a profession properly in the UK, and with firms like Metis and Dave's firm as well. It's just a better way to operate. You enjoy it more, and customers and clients and future prospects actually get in touch with you, as opposed to them that you say, well, all the guys I know are driving Range Rovers.
This reaches absolute zenith, Carl, in the UK. I mentioned this before. I'll do it very quickly. At the turn of the century, when stakeholder pensions came in, right, clean, zero initial charge, no exit penalties, but life assurance actuaries, who are some of the brightest yet dimmest people in the country, thought, well, we'll pay initial commission to get some of these stakeholder commission. You get 6% initial commission on a 100k pension, stakeholder pension transfer, 6k to the IFA. The next day, some IFAs, not listed, but the same week, some IFAs were rewriting the business with another firm, getting another 6k and splitting it with the client. There was no, from a behavioural point of view, it kind of makes sense. There's no downside except for the life assurance share prices.
And look, and I just on that point, Nick, right? I've said this before, but the providers, the pension fund providers, have so much to answer for, and I have a story right now.
Go on,
and I'm going to bite my tongue for now. But no,
lawyers
I may tell it. I may tell this story because it is not okay to be talking about, oh, Jimmy down the road has moved all his business. He's a disgrace. But then Jean over here is reintroducing business from another company here, and Jean is absolutely magnificent.
Yeah, we love her, yeah.
Right? But if you're doing something for the right reasons, you can't get pissed off. You set up this model. Central Bank, please come in and stop this. If you only stopped one thing, say that you cannot pay commissions on pension transfers. Watch the market just contract like that. The people offering the best advice will survive and thrive.
Yeah.
The Dave Quinns of this world, the other folks in the Ideas Exchange who are all doing financial planning. Rob Downey's, you guys you've met, right? There are lots of people out there. Jane McAleese, right? Sorry, I shouldn't start naming names because I leave people out. But there are people doing it right, and then there are people who are not. Central Bank, please step in and help us.
Well, that was very heartfelt. Very heartfelt. Okay, well, listen, we're now at 83 minutes in. Let's move on to Culture Corner. If I can find bloody Culture Corner.
I've got it. I'm first
I haven't
up.
got Culture Corner? I've got Culture Corner. There we go.
Oh, there we go. Well done. Talked about technology earlier on. I have tried a facility called Whisperflow. I'll put the link. It's spelled weirdly. Whisperflow.ai. Here's the thing. I'm of that generation that never learned to type. You're on a keyboard and I'm writing long things and Word docs and Google Docs and what have you. And it's always a frustration to me. And you've got this kind of spell check and all that stuff. Whisperflow, I can just literally do it on your phone, but I use it on a laptop. I can just talk. And it's the accuracy is unbelievably good. Free. It's free up to a certain amount of usage, and you just talk. Open up your sort of microphone on your laptop, speak, and it just will speak. It will type perfectly, word for word, how you say. I found that very, very helpful. As they're all about little time savers, little hacks, little useful. So check out Whisperflow. Yeah.
I tried it. I tried it this morning. It's very good.
And before we go, I've got a bonus one because it's hot off the press. Great friend of Trap, Mike Legasic, has just published his latest book. The latest book is called The Art of Storytelling for Financial Advisors. I shared it with you guys because as soon as it was announced at the weekend, I bought it, downloaded it, put it on my Kindle, started to read it. Haven't finished reading it, but already it's really good. I can tell he's kind of coached in the Nick Murray school of writing. It's very kind of, poetic, nice, really nicely worded. And the whole the kind of front page dedication or acknowledgements is an entire page in support of Trap and names of 4 of us. So, Mike, thank you very much for your kind acknowledgement of us. Hope you have been of some help. But honestly, we all know that storytelling is such an important part of the financial advisor's job. That's what clients engage with. It's stories, not spreadsheets. Learn how to do the spreadsheets, but really learn how to tell the best stories and engage with your clients. So everyone should rush out and buy that book from Mike Legasic.
Okay, excellent stuff. Wodge.
The Week in Charts, I think it's a podcast as well as a YouTube channel. Charlie Bilello and Peter Maluk. I mentioned it before. It's just brilliant. It's absolutely brilliant. And separately follow Charlie Bilello and Peter Maluk on LinkedIn or Twitter or wherever you want to go. These two guys just nail it every time. And if you're of a similar mindset in terms of investment philosophies as we are here, then they'll give you great material to be able to share with your own clients. And Peter Maluk is one of the most probably the planet's most successful financial planning scale firm. So follow him. He's a super interesting guy, and certainly he's almost as prolific as Alan on LinkedIn with his posts and stuff. But it's really, really good. So follow both those guys, and they will certainly enhance your research and ability to talk to clients about some of the important investment stuff.
Yeah, Charlie produces insane content. Really good stuff. Nick, your point, Nick?
I'm just reading something. I haven't finished it yet. It's you. I know that you've read it and sort of poured over it to the nth degree. Poor Charlie's Almanac, Charlie Munger's book, a compendium of his 11 speeches he gave. It's just recently been updated, so I'm going through that. So when I finished it, I might report back on that.
Sorry, just about that, Nick, have you bought the original one, the big blue one, or have you bought the recent updated one, the stripe one, the stripe press did?
I bought the black. I bought the blue frame with the grey photograph because it's on Kindle.
That huge.
It's actually.
I was given it as a gift by Jack Butcher.
Yeah, blue book.
Check out Visualize Value. But yeah, it is. Every coffee table should have one. That's one book, Nick. You should have the hard copy, not just Kindle.
Yeah, you look really intelligent, Nick.
As if
you telling the man to do, Alan?
All right, finish up.
Final point.
Final point from myself is an author I love, Malcolm Gladwell. He's come out with the books Tipping Point, Outliers, Talking to Strangers, David and Goliath. He's got a new one called Revenge of the Tipping Point. Have I spoken about this before? I've got a bit of a deja vu here. Anyway, it's called Revenge of the Tipping Point, Overstories, Super Spreaders, and the Rise of Social Engineering. It's really good. Listen to it on Audible. It's read by the author. Superb storytelling. This guy is world-class storyteller. So it's a storyteller theme today.
I haven't told one for a while.
Our in-house storyteller.
I think of one for next.
Ladies and gentlemen, over and out.
I've got to say and the link to all these culture corners will be in the so-called show notes. The link to the Malcolm Gladwell book is almost as long as the book. Amazon, what are you doing? That goes on. That's like a.
I don't know why it's so long, Nick. Sorry.
Did that have a tiny CC or whatever you call it?
I know. Tiny CC / IFA forum.
Always be selling.
No. Sorry. Right. Okay. I think we're done. There we go, dear Trappists. Episode 73 comes to a close, and another pile of Trap slides down the U-bend of Father Time. Please do leave a review on iTunes, or your app of choice if it lets you. We're kind of running out of reviews. We don't care 1 star. We don't care 5 star. We love 6 out of 5 stars. But until the next time, it's adios from the Trap Pack. Take care out there, folks, and we'll see you on the other side.
Jesus Christ. It's about 400 degrees.
You don't have air conditioning.
Why is it so hot, Carl? Just this top of the building?
Yeah.
Yeah. No. Don't be ridiculous.
Bye, Trappist.